What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. My name is Alex Savanovich. I am a trader slash investor at Spoonbill Partners LLC. I trade stocks, bonds, derivative products, and a whole bunch of other stuff. If you can name it, we've probably traded it. On today's episode, we are going to continue with our normal model. I'm going to comment on some silly things I've seen in the tape, some interesting things I've seen in the tape. I've made a couple notes here, so hopefully you find this episode as interesting as I do. So without further ado, let's jump right into today's episode. First thing I want to talk about is Cerberus. Cerberus was an IPO not last week, but I believe the week prior. So it's been a couple weeks now, and there's been a bunch of syndicate between then and now. So I'm going to try and remember the details of the deal. Obviously, it was one of the biggest ones we've had this year in terms of hype. There's a few more in the pipeline that I think are going to be more hyped than that one, i.e., SpaceX, OpenAI, Anthropic, and various others. But so far, up until this point in the year, Cerberus was the blockbuster IPO of the year. It was 20 to 30. I think it ended up being like 30 times oversubscribed, something crazy like that. They priced the IPO at $185 a share. I think the stock opened for trading on the first day at 350 and then traded up a little bit. I want to say to like 380 for a minute or 2 minutes and then instantly fell back down. And the stock has not found a bid since the IPO date. I want to say yesterday was the first day I saw it gap up on the open. So, the stock hasn't broken the deal price yet, but we were getting sort of close-ish. I want to say the stock was 240 at the low 2 or 3 days ago. Now, I don't really want to get into all the details and what Cerberus does. If you're interested, you can search it up online. I'll give you the quick overview. Basically, if you think of NVIDIA's chips are good for training large language models, Cerberus specialized chips, or otherwise known as WSEs, wafer something engine, wafer super engine maybe. It's basically a chip built on an entire silicon wafer as opposed to slicing up the wafer into pieces, and then you have a yield of a few chips per wafer, sort of similar to the way that NVIDIA does it. Essentially, Cerberus has this idea where their flagship technology is the WSE, and it's a much larger chip. It requires different cooling needs. A lot of the data centers that have been built out have been built around the infrastructure that the NVIDIA chip has. And so it's interesting technology for sure. Their whole value prop was that they had this backlog with OpenAI. Funnily enough, the backlog was, I think, 80 to 90% OpenAI, which sort of raised some eyebrows. It definitely raised my eyebrows. I thought that was interesting, especially given you consider OpenAI as a company for a second and how many commitments they have to other companies elsewhere and what happened to Oracle stock when there started to be some angst around OpenAI. Oracle stock obviously got punished, and it's no surprise to everyone. Everyone knows what happened to the credit default swaps there. Anywho, I'm getting too into the weeds on Cerberus specifically as a company. I want to discuss the price action in the Cerberus IPO following the IPO. Obviously, the stock traded down day after day after day. Now, that did sort of coincide. Some people will say, well, the semis sold off at the same time that Cerberus sold off. All the semis were selling off. Well, okay, time out for 1 second. Yes, that is true. While there was some down days in the semis are not off a whole lot. And I want to say since the Cerberus IPO, there's been more up days in the SMH and the SOXX. I think that's a fact, actually. There's been more up days in these semiconductor ETFs than there has been down days, whereas Cerberus has been down every single day since the IPO. So obviously, there is some company-specific selling pressure in that name. And frankly, Cerberus is a brand new company. I don't know that they're even included in many of these ETFs yet. Frankly, for them to be included in these ETFs, you have to be buying Cerberus. So just think of that. Even if these ETFs started to purchase Cerberus to include them in the ETF, those buy inflows into that stock have not outweighed the selling. Just look at the price action in Cerberus. So what's going on here? I paused to think about it for a second, and I read a few interesting articles regarding SpaceX and how big the deal is and how there is a massive pipeline of huge IPOs. And there's just not enough demand in the market for these IPOs. And you can start to see, if you're noticing and you're paying attention, you start to see there are stocks in the marketplace who've traditionally been the most loved names. And I'm pointing to NVIDIA first. NVIDIA reported what I think was on paper, a great quarter. There's not a whole lot to pick apart there. They initiated dividend. There was a lot of good stuff there. Obviously, Jensen Huang is going to do his promotional nonsense. And the stock was flat on the day when they reported, and then I think closed red. And then if you look at the next 3 days, the stock sold off nonstop, and I think only found a modest bid today. At the time of this recording, it's Thursday, May 28th. So what's going on? Why are we selling these supposedly good companies? Obviously, everyone thought Cerberus, like this technology, it's the hottest technology. It's what everyone's talking about. It's in the heart of AI. Everyone loves AI. Everyone's pouring billions and billions, trillions of dollars into AI, buying these stocks, pressing these names at all-time high valuations, using crazy justification methods to justify why we're purchasing these names at these crazy valuations, no matter how you slice it, no matter what your valuation metric is. What is going on? What is up with the price action in NVIDIA and Cerberus specifically? And I want to focus on Cerberus, obviously, because they were a recent IPO. I think there's just better stuff coming down the tape, or at least the market thinks there's better stuff coming in the pipeline. There's a huge SpaceX IPO. There is Anthropic, there is OpenAI, and there's various others coming next week. There's sort of slightly smaller deals, but there's this Quantum coming, which is a quantum computing company. And there's just a lot of syndicate supply in a very short period of time. And to find buyers for all of that is not an easy task. And so what do people have to do? They end up having to sell their current holdings, or in the case of Cerberus, you IPO'd at 185. Anyone who was an investor at round A, B, C, D, whatever, that has this great cost basis, they had a huge return on day one. The last possible chance you could have invested in Cerberus before they officially went public and traded in the marketplace was the IPO day. You got a price of $185 a share. The stock opened at $350 and then traded in the 300s for a few days. You've roughly doubled your money, and you know you've got all these other names coming down the pipe that you've got to make room for. Why not sell your stock? Take that opportunity. Obviously, if you have stock from an earlier round or you're an insider, there's lockups and things preventing you from selling your stock. But if you're an ordinary investor, if you're like me or some other person who invested and participated in the IPO, it's not a bad half bad deal to get out at 350 when you know there's other stuff you want to participate in down the line. And so I think that's what's going on, and that's what's going on in some of these other names that have been loved, have experienced the same sort of hype that Cerberus had, that may not have just IPO'd, maybe have been trading in the marketplace for tens of years. Names like NVIDIA, for example, who are experiencing some odd selling even after good news and tons of hype, because we have to make room for all of the supply that's coming into the marketplace in the form of really hot IPOs in the pipeline. So this is nothing new for everybody. I know this is a dynamic that's been discussed at length on Wall Street. I've heard many people bring it up, but it's just something that I wanted to shed some light on. And I really thought that Cerberus action since the IPO was super interesting. And it got me thinking, and then I started to read about NVIDIA, and I started to read about all the stuff in the pipe, and it started to piece together for me, and so I wanted to discuss it on the show. So moving right along from Cerberus, the next thing I wanted to discuss was Goldman Sachs moving their S&P 500 target to 8,000. And with that coincided this potential deal with Iran. Trump needs to approve the deal that's on the table currently, and there may be a resolution on the enriched uranium projects that Iran has. So it looks like things are coming to a close nicely in Iran, potentially. And it feels like geopolitical tensions are easing a little bit. And I wanted to bring up the S&P target raise at Goldman, and I'm not, poo-pooing anyone at Goldman or saying that that's crazy. Could the S&P get to 8,000 one day? Given how the market's been trading, no doubt in my mind, eventually we will get there. But I think to do that call, to raise your price target on the S&P to 8,000 on the back of Iran and no additional geopolitical risk. Remember, the market's been pricing in for weeks this deal with the Middle East coming to fruition. You can see it in the tape, just the way that we've rallied. I don't think it's any surprise to anyone. Obviously, Donald Trump did not want to get into a hot war or engage in boots on the ground in the Middle East whatsoever. So he was incentivized, obviously, by his party. And I think by many people close to him, everyone realized how unpopular this war was. And so there was an obvious incentive from the government to engage in peaceful dialogue and negotiation to get this deal done. And all I'm trying to say is, a lot of that was already priced into the tape. You've seen it. The S&P's rallied nonstop since essentially the hot war ended, and there's been a lot of ups and downs. There's obviously been a lot of headlines between then and now, but the general pattern has been we've trended higher. And so I think a lot of that excitement and enthusiasm is already baked into the tape. The other big risk is although the market seems to act fine and we've baked in this resolution in the Middle East, oil is still at elevated levels. Yes, it has come off because there's a little bit of risk off the table in the Middle East, but oil is still at elevated levels. And I think the company that sticks out the most to me that actually commented on the price of fuel impacting their business was Walmart. Walmart grew top line and bottom line stayed essentially the same. So what does that tell you? Some cost somewhere caused top line dollars not to flow down to the bottom line. And that's just one example. You're going to start to see many examples of that in future quarters. Inflation is not cooling off. If anything, inflation is heating up and is still running hot, and that's a risk for the bond market. But I don't know that it's prudent to raise your price target on the S&P to 8,000 given the risks in the tape still. I mean, although the geopolitical risk might have calmed down a little bit, there is still a lot in the ways of fuel prices. There's earnings risk. If Walmart's telling you that we couldn't grow the bottom line because of certain costs that stayed elevated throughout the quarter, that's only going to show up in other companies. It's just going to take some time. I remember I said on a past podcast episode, these inflation figures, these fuel costs might not show up in the quarter that was just reported because the war occurred sort of partway through the quarter. But let's wait for Q2 of 2026 and see what companies start to say about fuel costs, especially if fuel retains this geopolitical risk premium. Because remember, oil is not going to go back to the price that it was pre-war. There's always going to be a little bit of premium built in now that a war has just ended, but we're still just coming out of that and a deal hasn't officially been inked. So there's still a lot of headwinds. There's still a lot of clouds. I would say before, the clouds were dark and you couldn't see the blue sky, and maybe the clouds are starting to part a little bit, but there's still clouds. It still rains every few days. There's not a clear blue sky and sun shining down. We're far from that, in my opinion, and there's still a lot of risk. I think there's a lot of risk to companies' earnings. I think inflation is going to continue to harm the consumer, and so we're not completely out of the woods yet. I just don't know that the S&P getting to 8,000 occurs by the end of this year. So that's all I wanted to say on the Goldman thing. A lot there, a lot of word salad there. I just thought the timing of them releasing that price target raise on the S&P was interesting given what I've been reading and what I've been seeing go on in the tape. The last thing I want to discuss today, there was actually two things, but they're sort of go hand in hand, so I'm going to blend them into one. Everyone remembers the Intel deal with the United States government where the White House basically made an investment in Intel. Obviously, I think that was done to create this sort of TSM-like competitor in the USA so that there wasn't as much reliance on TSM in Taiwan because of their geographical proximity to China. And as of more recently, there was an announcement by the White House where the White House is now going to invest in various quantum computing names. They want to get involved in that business, obviously leading cutting edge tech. And today there was an announcement, not an official announcement, no company is officially getting any money yet, but the drone stocks ripped today because the Trump administration said that with the United States military, they want to work on drone procurement and making drones cheaper. So there's a lot of this investment from the US government into private sector companies. US government's making a bunch of these investments in private companies. And I recently had an interesting discussion with a colleague of mine where he was making the argument to me, because I was saying that I'm a pretty big supporter of free market capitalism, allowing the free hand to do what it does best, and resources will get allocated the most efficiently if you let consumers and customers vote with their dollars for the best products, and so companies can compete on price to deliver the best product possible at the best price point possible. Now, I know that hasn't always worked out perfectly in society. There's been many cases of it. And when the government gets involved in subsidizing certain programs, things actually become more expensive and service becomes worse because there's no incentive to deliver a good product because customers aren't actually voting with their dollars. The government is just paying blindly. And so my friend was making the argument to me that, hey, like the US government investing in these companies is great. And obviously the US government is incentivized to do so because, we are very reliant on China for various things. And we would like to have our own TSM like chip company in the US. And we want to be able to rely on ourselves for drones. So if we need to go fight a war somewhere, we're not competing with a nation who maybe we bought drones from a company within that nation. Not that I think the US would ever do that. There's some great technology in the US. Anduril's doing some crazy things. But the US is engaging in these nationalistic investments to bolster their own supply chain and reduce reliance on neighbors or even competitors like China. And so, what do I make of all this? I think it's a good thing for a couple of reasons. Number one, yes, I'm a supporter of free market capitalism, but when your biggest, most major competitor is a command economy like China is, they don't play by the free market rules. They subsidize, they mandate, they strategically dump, they restrict exports, they restrict imports. So while I do support free market capitalism and I think there's a lot of good outcomes, if your opponent is running a state-oriented economy, I don't think the US is really distorting free market capitalism by investing in companies within the US, like the rare earths, drones, semis, quantum computing. They're not cheating. It's responding to a competitor to remain competitive. And I would argue that remaining competitive as a nation is in some way the most honest engagement in the reality that we live in, the most honest engagement in free market practices. The second point that I will make is national security is sort of the market here. All of these investments that I mentioned, obviously Intel fabs, rare earth processing, domestic drone procurement, it sort of underpins the infrastructure that allows a free market to flourish. You can't actually have a free market economy or society if your semiconductor supply chain is heavily reliant on an economy slash country like China. Your critical minerals are controlled by an adversary, and the defense technology depends on foreign suppliers. So I would honestly say these aren't really handouts to failing companies, although some would argue that Intel was in pretty rough shape when the investment came. When the investment came along, but you're sort of building the foundation layer by doing this. You don't get to enjoy capitalism if you lose the ability to defend your nation and the system that enables free market capitalism. So I would say for the US government and for anybody who says what they're doing is not technically free market capitalism and wants to take a jab at me for being a capitalist and supporter of the free market and then also witnessing what's going on with these investments and saying that I'm contradicting myself, I would say that the most capitalist thing that you can do right now is to make sure capitalism can survive the next 20 years. And that's essentially what these investments are, is enabling that system to survive into the foreseeable future. And because I'm a trader, some of these moves in some of these stocks after these investments are made are wild. There's a lot of volatility and there are some good opportunities to trade. I'm not going to say what I've been trading or how I've been trading them, but there are some great opportunities to trade. And so that definitely keeps things exciting, especially when we are just coming off the earnings season and there's not a whole lot to do other than look at the syndicate calendar and figure out which IPO I'm going to participate in next. So with that, everybody, thank you for listening to this long-winded episode where I babbled about maybe some things that you didn't really care about, but things that I thought were interesting and I cared to talk about. So I guess that's all that really matters. I don't know that how much of that really applied to the title of this podcast. That makes zero sense. Maybe I just made things more confusing for you. Let me know in the comments. That's what they're for. And make sure to follow me on TikTok, on Instagram, and on YouTube so you can catch all the shorts that I post as well. I try to do a daily market update and I definitely post clips of these podcast episodes. So thank you so much for listening. I hope you have a fantastic Friday and an even better weekend. Take care and I'll catch you on the next one. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.